For Coke, I go to financeyahoo.com. Come on, work with me. Currently, that's 285%. And growth rate of dividend is pretty much more difficult to estimate, but Coke being a company that is pretty much representative of the overall economy, and we think of this growth rate as the kind of average growth rate for a long term, taking the predicted growth rate for long run, and we can take G about 5%. A lot of long run growth rate of the U.S. economy is about 2.5%, and inflation roughly there as well. So for gold, 285 plus 5, 785%. Chucky's here, not Chucky, Swansea. Next time I go to Wales, I actually want to visit Swansea. It's in southern Wales, but seacoast. One problem with using dividend yield, as you know, dividends are discretionary. Companies decide how much per share dividend they're going to do. They could pay zero if they want. They could pay double if they want, what they're paying now. And dividends are discretionary. And they are not the only means with which firms return cash to their shareholders. We don't, we view dividends are the only way. Stock is a tax flow, but that doesn't mean that the company does not have other means to take their own cash and give it to their shareholders. Dividends are simple. All the cash of the company is in my right pocket. I decide that I'm going to pay $3 a share. I take $3 from my right pocket, put it into my left pocket as a share. That technically doesn't change. Of course, I can decide to put that $3 back into the company. That's good. Another way, another way companies return cash to their shareholders, or can you think of other ways? Do you know what way a company can get cash from their shareholders? Happens when a company goes IPO. More often than not, company issues new shares offers them to the public. And public decides how much they're gonna pay for those shares. Technically, the company decides on the price, so that's based on the market. Yeah. Some of the IPOs, existing shareholders are getting out, especially for tech companies. Venture capital investors get out at that time. But that's one of, but company stock offerings are not limited to the recent public offering. Anytime they want, they can do additional public offerings. And okay, we need cash, we can borrow, but we don't want it. How about we issue 1 million shares, you guys decide how much you want to pay. That's called a season or secondary public offering. Secondary equity offer. Firms can do exactly the reverse. Sometimes firms have a lot of cash. Example, you know my favorite company in the whole wide world, NVIDIA. Actually, 2 days ago, I bought some options. Finally, I felt right enough to actually think about the stuff. Let's look at their financials. Come on. And I am on a hard connection. Let's look at balance sheet. As of the last, they have about $54 billion of cash equivalents, and short-term investments. These are basically very liquid assets. A company like NVIDIA doesn't need that much cash. General rule of thumb is in order to run your operations, you need what we call some operating. Just like you go to a gas station, they have some cash in their checkout machines, right? But you don't, if you're selling $10,000 worth of product, you don't need $10,000. You need some percentage. It varies from industry to industry, but worst case scenario, the operating cash should not be more than 5%. Well, let's look at their revenues. Annual, 5% of annual revenues. Let's look at their revenues quarterly. Let's do quarterly. Oh, this is TTM anyway, okay. The trailing 12 months is 165. Slightly over 80. NVIDIA is carrying about $45 billion of excess cash. In fact, that amount is going to increase quite a bit. They're going to announce their earnings next Wednesday, I think. That's one of the reasons I bought the options. By the way, with trading options, typically the week before earnings are announced, the so-called implied volatility of those options increase. Is that earnings announcement introduces extra uncertainty? It's got high, it's got low. If it's higher than expected, the bank explodes. If it's lower than expected, it tanks. So if you're gonna buy options, do it at least with the expectation that it's gonna go up at least 1 week before or maybe 2 weeks before. Even if there is no actual price movement until the earnings announcement, since uncertainty increases value of the option, you can even make money with that. We actually cover those in the finance for money. There's gonna announce earnings of $1.25 a share. Let me see how many shares they have, they use. Come on. Up here. About 24.5 million shares. I'm sorry, that's billion actually. Units are in thousands, I think. Yeah, whole numbers in thousands. So multiply that by $1.25. $30 billion of additional earnings. So by the end of next Thursday, by beginning of next Thursday, we know that these guys will have about $83 billion. Sometimes shareholders actually protest these things, especially for firms that kind of maturing. I mean, you're basically holding that at very low rates of return. The best you can earn is pretty much the short-term interest rates, which are about 3.5, 4-ish. But if you leave that money back to me, I can invest it anywhere I want. I can even reinvest it back to the company. Presumably, NVIDIA has higher expected return than Ford, right? You keep the money inside the company, you're not earning. What companies do sometimes in these situations have repurchase transaction, buyback. They go to market just like they're offering new shares. They're saying, we're going to buy this $1 billion of stuff from market. They don't necessarily tell you on what day they're gonna buy it. They typically have repurchase programs and they buy it. That's another way of returning money to the shareholders. That's why dividend yield is kind of underestimating what sort of yield shareholders have, or what sort of